Usually when we talk about the property market, um, it feels like we're trying to describe this chaotic, just totally unpredictable weather system.
Oh, absolutely. It's been wild.
Right. Like for the last few years, trying to navigate the real estate landscape here was essentially like trying to drink from a fire hose in the middle of a hurricane.
Yeah, that is a very accurate way to put it.
I mean, prices were jumping overnight, buyers were panicking, and there was this overwhelming, very real sense of, like, if I don't buy today, I will literally never be able to afford a home.
It really was an environment that was entirely defined by intense, just unyielding pressure. I mean, that fear of missing out, it wasn't just an emotion, right?
Right, it was driving everything.
Exactly. It was the fundamental mechanical driver of transaction volumes across the entire country. But the weather has fundamentally changed.
It really has. And that is exactly why today we have gathered this massive stack of recent industry data, official URA statistics from the first quarter of 2026, and a whole slew of comprehensive market analyst reports.
It's a lot of data to sift through.
Oh, yeah, tons of it. But our mission for this deep dive into the source material is really simple. We are slicing straight through that daily noise, to look strictly at the mainstream Singapore private residential market.
Right, just keeping it focused.
Exactly. We want to give you, the listener, absolute clarity. If you are a general buyer or a general seller right now, we want you to walk away from this conversation knowing exactly whether it's the right time to buy, sell, or maybe just wait.
And to achieve that mission, we really have to start with the single biggest market shift of the week. That frantic, highly pressurized market of the past few years. It is officially over.
Done. Finished.
Yeah.
The fever has finally broken.
Yeah, we have entered what market analysts are consistently calling a Goldilocks phase.
Mm-hmm.
It's not too hot and it's not too cold.
Just right, basically.
Yeah, right. The numbers across the board are showing us this stabilizing two-speed market. Developers are finally pricing their new units sensitively, and buyers who have been sprinting on this financial treadmill for years, they finally have some breathing room to actually sit down, look at the math, and, think about their decisions.
So what does this all mean? Let's unpack this right away. Because a Goldilocks phase, it sounds incredibly comforting, right?
It does sound nice.
Like everything is just perfect and easy. But when I was looking at the Q1 URA numbers in our notes, I actually had to do a double take. This cool down hasn't necessarily made things simpler for people on the ground.
No, not at all.
Instead, it has created this massive pricing gap. It has triggered what I can only describe as the great buyer-seller standoff in the secondary market.
That's a great name for it.
Yeah. So what does this actually mean for someone trying to make a move right now?
Well, it basically means we are looking at a market that has split into two parallel universes. On one side, you have brand new properties launching straight from developers. And on the other side, you have resale properties in the secondary market. And the chasm between them, it has grown to just historic proportions.
Let's give you the exact figure so you can picture the sheer scale of this.
Ow.
Right now, in early 2026, the median prices for new launches are sitting around 2,550 to 2,570 Singapore dollars per square foot.
Wow.
But if you look at resale non-landed properties, meaning older, already completed condos, they are hovering around 1,770 per square foot.
Yeah, that is a massive 40 to 45% pricing gap.
It's an absolute canyon between two properties that might literally be sitting right across the street from each other.
It is a staggering difference. I mean, if you are a buyer, you're looking at a new launch and a resale unit in the exact same neighborhood, and that new unit is almost half again as expensive on a per square foot basis.
But we have to understand why that gap exists, right? It's not just developers being overly ambitious or greedy.
No, not at all. Developers are grappling with severe structural cost increases. Land acquisition costs are higher. Construction materials have permanently inflated since the pandemic disruptions. And their own financing costs to build these massive projects are significantly steeper.
Because interest rates are what they are.
Exactly. So to simply break even and make a viable margin, they mechanically have to launch at that 2,550 per square foot mark.
Right. Their baseline for survival has just moved up.
Yeah.
Meanwhile, the person selling the resale unit might have bought it a decade ago at like 1,200 per square foot.
Yeah, so they can comfortably list it at 1,770 and still walk away with a massive profit.
But wait, this brings up a massive question for me. If the resale market is 40% cheaper, Shouldn't buyers just be flocking to the secondary market and snapping up every single older unit available?
You would think so, mechanically speaking.
Yeah. Why on earth are our sources showing that resale volume plummeted in early 2026 to around 2,051 units? That is the lowest transaction volume we have seen since the second quarter of 2020.
Which we should probably remind everyone was the absolute height of the global lockdowns.
Oh, right, when you physically could not leave your house to view a property.
Exactly. To see volumes drop back to that level now purely because of market mechanics is highly significant. And to answer your question about why buyers aren't just snapping up the cheaper resale units, it comes down to a phenomenon called price stickiness.
Which is really just an economist's way of saying sellers are being incredibly stubborn, right?
That is a very fair translation. Let's break down the mechanics of this staring contest, starting with the sellers. We are seeing extreme price stickiness because the everyday property owner in Singapore right now is exceptionally financially healthy.
Employment is stable, that sort of thing.
Employment remains stable, yes. But more importantly, many of these sellers locked in their properties and their mortgages years ago under very manageable financial terms. They are not distressed. Nobody is forcing their hand.
So they aren't looking at the current market reality. They're pricing based on what they wish they could get, that aspirational price.
Yes, it is pure loss aversion. What's fascinating here is a seller looks at their neighbor who sold at the absolute peak of the frenzy in 2023, and they say, I want that exact same price.
Even though the market has cooled.
Right. And without any urgent financial pressure to liquidate, they are perfectly happy to leave their property sitting on the market at an inflated asking price and just wait. They feel absolutely zero mechanical need to offer a discount.
It really feels like a giant staring contest. Sellers are holding firm behind their shields because they have the holding power, and buyers are just refusing to blink.
And the buyers are refusing to blink because their psychology has shifted too. Buyers are becoming highly selective and entirely value-driven.
So they look at that 40% premium for a new launch and think, no way, I'll go to the resale market.
Yes. But then they enter the resale market, see these stubborn sellers refusing to budge on those high aspirational asking prices, and the buyers say, well, I'm definitely not paying that either.
So they simply cross their arms and wait.
Which means the entire secondary market grinds to a halt. Transactions are only happening when both sides manage to somehow find that absolute perfect pricing sweet spot.
It's a massive standoff of patience. But here is the logical next step. Because the resale market is completely frozen in this standoff, and the city fringe new launches carry that massive premium, buyers who actually need to move now are changing their entire strategy.
They really are. They have to.
Yeah, they are giving up on the city fringes, grabbing the steering wheel, and driving straight out to the mass market for affordability. We are seeing activity flow directly into the OCR, the outside central region, which basically means the suburbs.
The data we've gathered strongly supports this geographical shift. If we look closely at the official Q1 2026 industry data, overall, private residential prices across the whole island rose by a very modest, stable 0.9% quarter on quarter.
Pretty flat.
Yeah, but the OCR, it completely outpaced the broader market with a 2.2% jump.
Over half of all resale transactions in early 2026 happened in the OCR. The mass market is literally carrying the entire property sector on its back right now.
It's doing the heavy lifting.
If you are listening to this and you've been priced out of the city center recently, you are probably part of this exact demographic driving the suburban surge. And you can see it in the new launch figures, too.
Oh, absolutely. The new launch numbers are very telling.
Let's look at Tengah Garden Residences. This is a massive project deep in the suburbs, and it achieved a stunning 99% take-up rate right out of the gate at around $2,111 per square foot.
Which is incredible absorption.
Right. Then you have Narra Residences over in the dairy farm area, which launched with a very steady, gradual absorption rate at $2,148 per square foot. People are just flocking to the fringes.
It's the natural search for an accessible entry point. General buyers who want to secure a private property know that the central and city fringe areas have essentially breached their maximum affordability thresholds, so the demand naturally migrates outward to where the math still works.
But here's where it gets really interesting, but also a bit concerning for you if you're out there looking to buy right now. I have to push back on this a bit.
Go ahead.
If everyone is rushing to the OCR for affordability, Aren't we just inflating a brand new bubble in the suburbs? I mean, if suburban prices are jumping by 2.2% in a single quarter, and we're seeing $2,100 per square foot in the heartlands, which frankly would have sounded like a joke 5 years ago, at what point does the mass market stop being affordable?
It's a very valid concern. Are we just moving the affordability crisis down the road? That is the most common fear when we look at these suburban numbers. But if we connect this to the bigger picture, we have to look closely at the mechanics of developer strategy to understand why this isn't necessarily a bubble waiting to pop.
That can lay it out for me.
It comes down to a crucial structural distinction in real estate: the difference between the per square foot price and the overall quantum.
Right, let's clarify that term quickly. When we say quantum, we are talking about the total final price tag of the home, right? The actual dollar amount you are borrowing from the bank.
Correct. The per square foot price in these suburban launches is indeed inching up to that 2,100 level, but developers are incredibly aware of the general buyer's absolute maximum budget.
They know exactly how far they can push it.
Down to the dollar. They know exactly how much a typical dual-income household can borrow under current financial regulations and debt servicing limits. If developers simply built the exact same sized apartments they built 10 years ago at today's per square foot prices, the final quantum would completely blow past what the bank is legally allowed to lend the average buyer.
The developers would be building homes that physically no one could buy.
Exactly the problem. So to keep that overall quantum, the final price tag, accessible, developers are leaning heavily into optimizing and shrinking unit configurations.
Oh, so you are paying more per square foot, but you are buying fewer square feet overall just to make the math work.
Yes, exactly. They're completely rethinking architectural layouts, they're eliminating long-wasted corridor spaces, they're integrating open-concept kitchens that bleed directly into the living room.
So no more massive separate dining rooms.
Right. Balconies might be smaller, and separate utility rooms might just be removed entirely. By shrinking the overall footprint, say, from 1,100 square feet down to 900 square feet for a three-bedroom unit, the final price tag remains sitting safely within that maximum borrowing limit of the general buyer.
That makes a lot of sense.
That is why demand remains so incredibly robust. It's a highly calibrated balancing act to ensure the mass market remains technically affordable, even as the raw cost of building goes up.
It's literally like shrinkflation at the grocery store. It's like buying a candy bar. You're still getting the chocolate. It still satisfies the craving. But the manufacturer made the bar just a little bit smaller to cover their rising ingredient costs without scaring you away with a massive price hike at the register.
That is a very apt, real-world way to look at it: shrinkflation for real estate. And understanding this mechanical adjustment by developers leads us directly to the most critical reason why the suburban surge won't lead to a disastrous bubble.
Okay, why is that?
The safety of the market right now is tied directly to who's buying these homes. And honestly, it is tied even more strongly to who has officially left the market entirely.
Right. The reason our sources aren't flashing red warning signs for a massive crash is because the fundamental DNA of the buyer pool has changed. We are witnessing the death of property flipping and the rise of the true, genuine owner-occupier.
The subsale data from the first quarter is the ultimate, undeniable proof of this shift.
Let's take a second to define how a subsale actually works mechanically, because it really highlights what we've lost, rather what we've thankfully gotten rid of.
Yeah, it's an important concept.
A subsale is when a buyer puts a deposit on an uncompleted unit from a developer. 3 years go by while it's being built. Right before it is officially completed and handed over, the market value has jumped 20%.
Yep.
That original buyer then sells the unit to an end user without ever having lived there, and often before even paying the bulk of the mortgage. They just pocket the massive difference.
It is the primary indicator of pure speculative behavior in the property market.
It's like the property market used to be a hyped-up, sold-out concert. The flippers were the ticket scalpers. They were buying up the entire front row just to turn around and sell them at a massive premium outside the venue before the music even started.
And what the data shows us is that the scalpers have essentially left the venue. In early 2026, subsale transactions made up a microscopic 5.5% of secondary sales.
That's practically nothing.
Exactly. That tells us, mechanically, that short-term speculation is practically dead. The people buying homes today are the people who actually want to listen to the music.
I love that. And the data gets even better for buyers. The industry reports show that unsold private home stock has dropped down to 17,029 units, which is the lowest level we have seen in 7 quarters.
Yes.
At the exact same time, physical completions of properties are rising. We're expecting about 7,000 private units to be physically completed, get their keys, and be handed over to buyers in 2026 alone.
That specific intersection of data, low subsales, low unsold stock, and rising physical completions is the textbook blueprint of a healthy and user-driven market.
It's like the market has finally digested a really heavy meal. But this raises a really important question for the everyday listener, though. Why does the presence of owner-occupiers make the market inherently safer for everyone else?
How so?
Like, how does a family living in a condo protect the value of the market better than a wealthy investor?
Ah, I see. It is about creating a structural price floor. Mechanically, a market anchored by genuine owner-occupiers is far less volatile because their motivations are entirely different.
Investors are quicker to jump ship.
Precisely. Speculators and flippers are highly sensitive to market fluctuations. At the very first sign of an economic dip or a rise in interest rates, speculators panic. They liquidate their assets to cover their margins, which floods the market with inventory and drives prices down rapidly.
But a family won't do that.
No, an owner-occupier simply doesn't do that. You do not sell the roof over your children's heads just because a quarterly economic report on the news looks slightly gloomy.
You might cut back on eating out at restaurants.
hmm
You might cancel a vacation, but you keep paying your mortgage and going to work.
Exactly. You hold on to the asset. This stubborn holding power creates a powerful floor under the market, preventing sudden crashes.
That makes total sense.
And if you combine this structural safety with the rising number of completed homes you just mentioned, it's very stabilizing. When 7,000 completed units hit the market, buyers who need a place to live immediately, finally, have actual physical options they can walk into and touch.
They don't have to frantically bid on uncompleted projects off a floor plan purely out of the fear that there will be nothing left in 3 years.
Exactly. The pressure valve is released, the urgency is gone.
So we have traced the entire logical through line of the current market. We looked at the mechanics behind that massive 40% pricing gap. We explained the psychology of the great buyer-seller standoff. We tracked the natural buyer flight to the suburbs where developers are shrinking floor plans to protect the quantum. And we've seen how the death of the ticket scalper has created a structurally safer foundation.
It's a very different landscape now.
It really is.
Yeah.
So let's synthesize all of this data into actionable takeaways for you, our listener. If you are a general buyer or seller looking at the landscape right now in 2026, what is your actual move?
Let's start with the sellers.
Good idea. If you are listening to this right now and you own a property you're thinking of putting on the market, the data is screaming one undeniable reality at you. Aspirational pricing will punish you.
It really will. The days of testing the market are over.
Because buyers finally have options and because their psychology has shifted to become highly disciplined and value-driven, you cannot afford to play games. You must price your property to sell, not to test the market's limits.
Right.
If you put an absurd peak 2023 price tag on your unit, hoping to stumble across a desperate buyer, your property's just going to sit there. It will gather dust in that 40% gap we talked about, while buyers simply walk away and look at completed stock elsewhere.
That is the harsh mechanical reality for sellers right now. The staring contest only ends when someone offers fair value.
And what about the buyers?
On the flip side of that equation, if you are a buyer, the narrative coming out of our sources today is incredibly positive. This is arguably the most balanced, healthy window of opportunity you have seen in years.
Because the frenzy is gone.
Right. The frantic fire hose panic of the early 2020s is gone. You have genuine negotiation leverage in the resale market because you know those sellers are stuck. And you have the time to carefully choose from a growing pool of completed stock without feeling rushed.
You can confidently walk away from a bad deal.
Exactly. You can walk away because you know there isn't a line of 20 anxious people standing right behind you waiting to overpay.
You actually get to be a consumer again, analyzing a product rather than feeling like a contestant on some high-stakes game show.
You can take your time, realistically assess your long-term finances, and make a decision based entirely on logic rather than fear.
I love that. Logic rather than fear. As we wrap up this deep dive into the source material, we want to leave you with a final, slightly philosophical shift to ponder. It's something that wasn't explicitly spelled out in the industry reports, but it echoes through every single metric and number we've discussed today.
I think I know where you're going with this.
With the era of quick, speculative flips officially dead, and the market transitioning firmly into the hands of long-term owner-occupiers, perhaps the ultimate value of a home in Singapore is permanently changing.
It's a huge mindset shift.
For decades, property here has been viewed primarily as a rapid wealth generation tool. It was a guaranteed stepping stone to getting rich quick. But what if that hyper-growth phase is simply over? What if the primary value of a property is reverting back to simply being, well, a home?
It is a profound shift in mindset for an entire generation of buyers. I mean, if you remove the baked-in expectation of making a massive guaranteed profit in 3 to 5 years, how does that fundamentally change your search criteria?
Exactly. How does that change the way you value and select your very next property? If it is a place to actually live for the next 15 years rather than just a temporary place to park cash, maybe you start prioritizing a slightly larger layout over the raw per square foot value.
You look at lifestyle factors instead of just yields.
Right. Maybe you prioritize the neighborhood vibe and the proximity to your kids' schools over the projected rental yield. It is a completely different way of looking at the map.
It really is. It changes everything.
So as you navigate this Goldilocks phase, keep that thought in the back of your mind. The fire hose has finally been turned off. You have the time, the leverage, and the space to find a property that is, quite simply, just right for you. Thanks for joining us on this deep dive into the source material. Keep looking beyond the noise, and we'll see you next time.